Welcome back to Financial Hustle University, episode number 201. Today, I'm going to tell you how you can be as wealthy as those real estate investors you watch on TV. I'm not talking about Donald Trump. I'm talking about those YouTube influencers, those celebrities on IG showing you their freaking mansions, their freaking 5-story homes, multifamily homes. You too can have that. It's simple. It's called the short-term rental loophole. What do I mean by that? A lot of real estate investors want to get the real estate professional status. They want to qualify for that because through real estate professional status, you can then do something called a cost segregation study. A cost segregation study allows you to do bonus depreciation. Bonus depreciation allows you to take a bigger expense, a bigger tax write-off at the end of the year and helps you save more money. A lot of my investor clients aren't qualified to be real estate professionals because to be a real estate professional, you need at least 750 freaking hours spent in real estate. That means you are treating that as your full-time job, not your W-2 job, not your 1099. If you're working at a W-2, you work 40 hours a week, 50 hours a week, there's no way you're putting in that type of time every single year. The IRS looks at this very, very closely. You want to get with a good CPA who's going to do a full analysis for you and make sure that either they let you know you qualified or you didn't qualify. But you're here with a Fitbit CPA, Financial Hustle University, episode 201. We're going to show you a loophole called the short-term rental loophole that is even better than the real estate professional status. Listen, there's two types of income, right? There's your passive income and your active income. Your passive income is your rental property, right? You've got one property, two properties. Your active income is your W-2 income, right? Let's say you're a doctor, you're an engineer, you make $200,000 a year, and you like to invest in real estate on the side. But unfortunately, being a high income earner also puts you in a higher tax bracket. I mean, think about it. Paying 24 to 37% to the freaking IRS every single year? Dude, if it were up to me, I wouldn't pay them a freaking penny. But that's where we come in. That's where strategic real estate specialized CPAs can help you grow your rental empire and be more tax efficient with your strategies. So, what do? You can't meet the 750 loophole hours requirement. What you do is you do short-term rentals. The IRS says that you can only offset your active income with active losses, not with passive income or passive losses. So any rental expenses, let's say you had 100K in losses, you can't offset that against your W-2 income. You just can't. It's not allowed unless you're somebody who does short-term rentals. What are short-term rentals? AirBnb, VRBO, right? 7 days or less, and you pass one of the tests to be qualified for bonus depreciation, cost segregation. You put in 7 days or less, and you meet one of the material participation tests. What are the material participation tests? Well, number one, 500 hours in real estate, right? That's definitely less than 750. Number two, 100 hours, and you provide some kind of personal service, right? Personal service could be cleaning, taking care of the property once tenants leave. Once your short-term tenants leave, you take care of the property, you clean it up, you make it nice, you do some business-oriented services. That's the 100-hour requirement. And number three, you put in the most hours put most hours, and nobody else but you put in the most hours in that rental activity. That, ladies and gentlemen, would then qualify you for tax write-offs that we all want, the sexy tax write-offs, the bonus depreciation, the cost segregation. You've got your short-term rental loophole test met. Now you've got the 100 hours test met, and boom, you can go ahead and take 100K in losses against your W-2 income. So instead of paying taxes on 200K, you're paying taxes on 100K because your rentals created losses of anywhere from 80 to 100K. Now this is all hypothetical. Your losses could be 30K, 40K, 50K. I don't know what's going on in your rental portfolio, but get in touch now, 407-990-2002 to see how we can help you there. Now, another question that a lot of people ask is, what about bonus depreciation recapture tax? What about the depreciation and recapture tax that everybody has to pay once they sell a property? Listen, this is the trick that the wealthy won't ever tell you about. It's called the 1031 exchange. There's going to be more lessons on the 1031 exchange, but the most important thing that you need to know about this strategy is once you do your short-term rental loophole qualification, once you've done the cost segregation, and let's say you've created losses of 80 to 100K every single year, instead of looking to sell that property, what you're going to do is you're going to do a 1031 exchange. You're going to move that money into another property, and then you're going to keep doing those for the rest of your life, right? Forever. You're going to keep kicking the can down forever. But guess what? Sometimes the can never comes back to haunt you, because when you die, your estate passes on to your kids, your grandkids, your great-grandkids, and they get stepped-up bases, which means they never have to pay any type of recapture tax. For more strategies, more tips, get in touch now. 407, let me write this down, 407-990-2002 for more tax planning and real estate strategies to make you into a freaking millionaire.